the second I realized that you can syndicate a multifamily, 100+ unit deal and bring investors together and partner on it, I just grew attached to that whole concept.
Welcome to the InvestNest Real Estate Investing Show, a community for real estate investors to learn, network, and grow. Be sure to join the investnest.com and start learning and earning today.
Hello, everybody, and welcome to the InvestNest Real Estate Investing Show. I'm your host, Travis Murphy, and this is podcast number 20. I'm very excited about today's Invest guest. But before we get started, I want to remind everybody to check us out on Instagram, Facebook, and Twitter at the InvestNest. Check out the investnest.com if you haven't already, and create your free member profile and start networking with the other real estate investing members on the website. And if you're enjoying the podcast so far, please hit the subscribe button and leave a review. And if you haven't been listening, the podcast is a weekly release where we have weekly guests join us, real estate professionals that share their journey with us. And today I'm really excited about our guest. As I mentioned, Jorge Abreu. He is an active and passive investor in the multifamily space. He's got over 1,700 doors on the GP side and 1,400 doors on the LP side. He's also CEO of Elevate Commercial Investment Group, and he has a construction company, JNT, that focuses on multifamily renovations. So he's got a lot of expertise, but we'll let him tell us a little bit more about himself. And now let's welcome our guest, Jorge Abreu. Jorge, how you doing today?
I'm doing good. How you doing?
Good. Thanks for joining us. I've been looking forward to this podcast for some time. You're a very busy man. You keep yourself active in the multifamily space, I understand. But can you tell us a little bit about yourself and what it is you do?
Yeah. So I've been investing in real estate for about 15 years now, full time. Quit my W-2 after I started making consistent money in investing in real estate. In the beginning, I was doing mainly single family, then transitioned into some small multifamily until I was introduced to large multifamily syndications. And till then, that was about 4 years ago. So for 11 years, I was working on scaling the single family and the small multifamily. Started my own construction company, and on that journey to all of it was to scale. Bringing in the construction in-house made it a lot easier to do the fix and flips. And the second I realized that you can syndicate a multifamily, 100+ unit deal and bring investors together and partner on it, I just grew attached to that whole concept. The fact that I had scale just in one property alone, something I had been doing for, trying to build for years. So at that point, once I got the education and kind of understood the underwriting and the fact that you were buying a business, not really a piece of property, both in one, I guess. Then I turned all my focus towards large multifamily deals. Same with the construction company. No longer touch single family and just do multifamily now.
Yeah, I mean I talk about that a lot on the podcast. It's kind of like that natural progression almost for people that are getting into real estate investing. You start with either single family or really a house hack a lot of the times. And then you get maybe a single family or duplex as a rental. You get into fix and flips to kind of fund your acquisitions. And it's all about building that, like you said, that experience and knowledge base to try to get to a point at scale. But when you get into that multifamily space, like you mentioned, it's more of an income generating business and an asset in one. But it allows you really, because the strength in numbers, it really allows you to scale much quicker. And it's not just you on your own. You're leveraging, financial institutions as well as other investors.
Good point. Yeah.
To be able to take these types of deals down. So, I mean, for you, I guess how would you compare the what goes into managing a bunch of single family rentals, because that's probably what a lot of our listeners are in the midst of right now, versus managing a large multifamily. I think a lot of people get scared off by the concept or the thought of a large multifamily investment. Can you share some of the differences that you could point out from your experience?
Absolutely, yeah. So I think you kind of nailed it with the fact that multifamily is a team effort. Um, to take down some of these large deals, you really need to leverage vendors, partners, etc. Um, Not so much when you're building a single family portfolio, um, and it's a lot more. The management side is a lot more hands-on when you're doing the single family. You can build um, an in-house property management in a sense, depending how many single family homes you have. Um, but there is going to be a rough patch there where you don't have enough and it doesn't make sense. The profits aren't there. Same thing with a third party property management company, to hire them to do your single families. Um, the profits are, you're going to need to scale first to be able for that to make sense. So I think that's the big difference. When you're doing 100 plus units, you can afford to hire the on-site staff and be a little more um, just managing the asset versus going and collecting rent.
Doing
Yeah,
the
it's
due
a lot of
diligence.
work. Don't get me wrong.
Yeah, for sure, for
It's a lot
sure.
of work. I mean, even after the fact, the asset management's no joke. You've got to be on top of your property and your projections, budget versus actuals, and whether you have in-house or third party, uh, you need to stay on top of it.
Yeah. I mean, that's the whole multifamily, whether it's syndication or however it's structured, it fascinates me too. The financials behind it and just the different ways you can structure things and take these types of assets down. It sounds like you're fully immersed in this, obviously, and you into all facets of it. So from reading up on you have units on the GP side, the LP side. You have it sounds like you're the CEO of a capital investment group, as well as a renovation company that does renovations on multifamily. So you've got, sounds like you've got all the aspects covered, all the angles covered in this. But I guess if you could explain a little bit how you typically structure your deals and what your active deals look like versus your passive deals.
Yeah. Um, we also do development projects too. Just
Oh,
wanted to throw that in there.
okay. Don't want to leave that out.
But each one is structured differently. There's some that it depends on the type of deal, the type of returns it's generating. If it's a uh, heavy lift, value add, not a lot of cash flow, that's going to be structured a little different than something that's cash flowing from day one, more of a management play, or some value add in there. But uh, we've got everything from a 80-20 split on the GP LP splits, from 30-70 flipped around.
Right.
GP 70, LP 30, um, and everything in between. We've got hurdles. We've got all different types of structures. If you bring in a pref equity partner, then you're most likely going to have hurdles in there. Um, so usually we'll take that same structure and just pass it over to the common equity as well, not to overcomplicate the deal. And then as far as myself, I started investing passively around the same time that I decided I was going to go active. So I was an LP on a couple deals until I landed my first active GP deal. And then, since then I invest passively, whether it's in my own deals or I still like doing other deals with other investors. I think it's a good way of building relationships. And um, yeah, I mean, every year I want to make sure I'm getting that depreciation. um, and not paying that much to taxes.
Yeah, I think that goes for all of us. There's a lot there, and I don't want to confuse all the listeners out there, but I think this is an area that interests people. So you mentioned, LP and GP. What's the difference there? Can you explain us what that means? Explain to us.
Yeah, I'm sorry. And I threw out hurdles and all this
Oh,
different
that's
stuff.
okay.
You've got a limited partner and you've got a general partner. So the general partner are the ones that are really making the decisions, the vision of the property, the asset, um, when it's going to refinance, when it's going to sell, what type of rents we're trying to hit, who's we're going to hire for property manager, et cetera. And then the limited partners are the ones that are investing funds and they don't really have control of the asset in that sense. They're trusting those general partners to do the best thing and generate the best returns.
Okay. Yeah, and then I guess your hurdles or your promotes are kind of goals or targets that if you can hit certain financial goals or certain financial targets along the way, those equity splits or returns then could change. Is that correct?
That's correct. So these aren't loans. The investors aren't. It's not hard money loans or anything like that. It's they're equity partners in the deal. So then it comes down to, okay, well, how does that equity get split up between the limited partners and the general partners? And a lot of different ways you can do that. One is, setting a split, saying limited partners are going to get 70%, general partners are going to get 30%, as an example. But if the general partners are able to hit, let's say, a 15% IRR, then once you hit that hurdle, it's going to jump to 50-50.
Right. Okay. And that kind of keeps everybody honest, right? So instead of just the general partners telling and promising what they're going to deliver, it kind of holds their feet to the fire and not only rewards them if they achieve it, but keeps them incentivized to achieve it, right?
Yeah. It keeps everybody on the same page. In a sense, you never want the general partners to get complacent and just not keep pushing
Hmm.
that property. So yeah.
Yeah, always want to keep the best interest of the property, which in turn would be for the investors in mind, right?
Hmm.
And so moving on to another area that sounds like you're very familiar with in the due diligence period or the underwriting process. I know those are two separate things, but you mentioned earlier, you can you can structure the deal up differently, 70-30, one way or the other, depending on if it's a value add or already cash flowing. What goes into identifying that and determining which direction to go with any particular potential investment?
Yeah, I mean it's gonna depend on how the asset's performing. How it's currently performing, how much meat is left on the bone. If you're trying to acquire a property that's already been 100% of the units have been updated, it's on the top of the market rent right now. It's collecting the top. Um, there's not a lot of value add in that deal. Maybe you're able to get it at a good price, which I'd be surprised right now the way the market is.
Hmm.
But that would be a cash flowing property if you can get some good financing, get it at a good price. It's probably going to give you some good cash flow, but it's not going to have that big equity kicker once you sell it. You're not going to have a refinance cash out, anything like that. So in that case, you're probably going to give more to your limited partners.
Right.
Um, and then another example on the other side of the spectrum is a property that's maybe not even cash flowing right now, and it's way under market as far as the rents, hasn't been updated in years, has a lot of deferred maintenance. Um, in that case, you're going to come in and reposition that property. Probably not going to have cash flow for the first year, so the investors need to understand, hey, this is not a cash flow play, but when we sell this property or even better, if you're able to refi cash out once the property's stabilized, um, it's going to have a nice return.
Mm-hmm. Yeah, and that, like you said, refinance, you're able to deliver return almost, if not all, the capital to the investors to then go and repeat the process. So
Yeah.
determining that play, whether it's a cash flow play off the bat with just more stable returns versus that, more upside potential, which comes with maybe a higher level of risk. That's all done during, I guess, when you're trying to identify properties and you're underwriting when you're underwriting the deal to evaluate what type of investment this is going to look like. To move forward beyond that, once you've made all those determinations, you get to a point where you're under contract. Then begins the due diligence period. What can you tell us a little bit about what goes on there and what the due diligence period is?
Yeah. So, before you get there, kind of like you mentioned, at this point you've done your underwriting, you've made an offer, and it's been accepted. So now you've got a sale agreement, right? And then your due diligence period starts. Usually it's about 30 days, and this is the time where you're going to verify everything. You want to financially and structurally, you want to verify that everything they're telling you financially is true. You want to see what type of criteria they've been using to get the residents, uh, what fees they're actually collecting, and try to see, what is any of the information they presented false, and also you can maybe find some other value add when you do that. And then there's the physical due diligence, is when you go and you inspect the property and all the major components of the property, and you also inspect every single unit. Um, so those 30 days are your time to confirm everything. And if you find something alarming, something you didn't see beforehand, then that's your time to bring it up to the seller and say, hey, look, we found, we scoped all the plumbing lines, all the sewer lines, and there's 4 that are cracked and failing. It's going to cost us $30,000. Give us a $30,000 discount on the price.
Mm-hmm. So the underwriting period is when you're doing all of your analyzing of the investment based on what the information you have or was provided to you by the seller. And then if you get to the point where you're under contract, the due diligence is where you go and then confirm all that information.
Yeah.
And hopefully discover maybe some hidden value, like you said, some value add opportunity that wasn't maybe at the forefront initially. And then as well, on the flip side of that, hopefully discover any defects that were maybe overlooked, that could cost you money down the road. Yeah, this is really cool stuff. And I know you keep very busy with all that you do. Do you have any projects going right now you could tell us a little bit about, or are you in the middle of any one of those stages in the process of an investment right now?
Um, we just closed on one a couple weeks ago, and then we're getting ready to close on another. We've already passed due diligence on those. Um, we've passed and there's another one that we're working on also that one's going to be a heavy lift. Um, we did we spent a ton of time on the due diligence because the capex is going to be um, very important on that one. I mean, it's very important on every single deal. So to me, the due diligence period is one of the most important when it comes to acquiring these properties, because anything that you miss during that period is going to affect your returns. If you've got to if you got to spend extra money on your capex, or um, you miss something on the collections. The collections was a lot less than you thought it was. Um, that's all going to hurt your returns and your projections.
Yeah, and not just you, but more importantly, if you're on the GP side, but it can hurt the returns of your investors. So
Absolutely, yeah.
That responsibility falls more so when you're the one when on the GP side, when you're the one pulling all this together. That reflects poorly on you, and that makes it harder to go and repeat the process. So I think I agree with you that due diligence period is a pretty critical step in the process.
Yeah, so we're very efficient when we do the due diligence. We've got our checklist, and we try not to miss anything.
Yeah. Well, and you touched on it. We haven't talked a lot about, but the whole capex aspect to it and what that means. Maybe some of our listeners aren't as familiar with it. Can you tell us about capex and what you meant there?
Yeah. So whenever you're going to acquire one of these assets, you want to make sure that you have the funds necessary to, one, bring the property back up to take care of any major structural issues, any deferred maintenance. When I say deferred maintenance is um, items that should be regularly maintained and that the current owner didn't take care of, meaning, you got roof leaks throughout, that's deferred maintenance. That should have been taken care of, but since they haven't, you want to make sure you have the funds to come right in and harden that property, make it, take care of the work orders and just make everybody that's there happy and let them know, hey, we've got a new owner and they're going to take care of us. At the same time, it also includes any upgrades. So if you plan on upgrading half the units, then you want to make sure that you have those funds set aside to upgrade all those units. You can't do that with just the cash flow that's generated from the asset. One, you won't be able to pay your investors returns, and two, you're probably not going to have enough. So I'm glad you brought that up because I do see a lot of investors that kind of leave out the upgrade part of it when they're doing due diligence, and they're just really worried about the deferred maintenance, which you should be. But at the same time, I think you need to be worried about the upgrades and make sure that you have enough money set aside for that. I've seen many times where investor groups don't bring enough to the capex, and then they've got to come up with a way to bring those funds to execute the business plan.
Yeah, and then that disrupts the financial model behind it. So from a business standpoint, people think maybe that you're listening out there, you've got your maintenance expense, which you're factoring into your monthly cash flow. Well, the capex is actually, like you said, it's capital expenditures that are going to go back into the cost basis of the property. So when you're underwriting an investment, that money allocated should be raised and factored into the cost of the acquisition, almost as if it was part of the purchase price. So you need to raise that money and have it accounted for. It's going to go into the initial investment, and all the returns that come off of it down the road are going to be compared against those capital expenditures in addition to your acquisition costs. So you really do need to separate those two out, because if you haven't, and then you go in and you're trying to pull out of the cash flow to make up the difference on the things that you didn't do from the capital expenditure standpoint, you may not have any cash flow, or your returns are going to be potentially highly diminished.
Yeah. You're also going to affect the NOI, which
affects the value of the property. At the end of the day, that's really what the goal is, right?
Mm-hmm.
To improve the NOI. And I'd love to sit here and talk to you about this stuff all day. NOI is probably, we'd have a whole nother show on it, but just real quickly, NOI and how it represents the value of a property. If you could just give us a quick rundown on what you meant there.
Yeah, I'll try to do a quick one there. You pretty much take all your income that you generate, you take all the expenses you have, so not your capex, like your true maintenance and everything that it takes to run that asset, and you subtract it from your income, and then that's your NOI. And then depending on what your cap rate is, you take your cap rate with your NOI, and that's going to give you the value of the property.
Yeah, and so the cap rate is basically the relationship between the value of the property and the net operating income, or NOI, expressed in a percentage, right?
Yep.
So you can compare properties in a similar market that you're looking at. If you know what the kind of going cap rates are, and you know the NOI of a property, in turn, you should be able to determine what the value of that property is.
Correct.
And by improving the NOI or raising the net operating income, even holding and maintaining that same cap rate, when you do the calculation, it increases the value of the property.
Yeah, it's if somebody hasn't done the math, take a 100 unit and you increase that rent by $10. So you take, 1,000 times 12,000. think I did that right. And you divide it by, let's say, a 6% cap rate. I I don't know.
I
What
can
is
see it.
that?
I was gonna say I can see everybody out there listening with their calculators on their iPhones out,
I
trying
used to
to
be
do
really
some
good at
numbers.
math, man, and then
It's
calculators got me. So you just increased that property's value by $200,000
yeah,
by increasing $10 in rent.
yeah, and that's really when you're going into these types of investments. That's really what you're after. After the financials have to work and support themselves, you know, for the most part. But that's like you said earlier. That's kind of where the payday is when you either go to and resell it or refinance and return the capital.
Yep.
Um, yeah, this is awesome. This is good stuff. I know you're busy. I don't want to keep you too long. I understand you're a family man as well. You've got, health is very important to you. Can you just tell us a little bit about, that part of your life and kind of what motivates you? And for people out there listening, they may be thinking this stuff is so far away from them and so unachievable, but how can people that are listening, you know, get into this or have confidence that they're able to do it? What was it about you that allowed you to do it, and what might be some factors out for other people that could do the same?
Yeah, I mean, I think it all starts with mindset. Um, for the most part, I think we're all capable of doing a lot and being very successful. Um, I think you got to win the mindset battle first. And you mentioned family, so yeah, I've got three little girls, and my family's my why, 100%. That's what motivates me. Um, and then you talked about also health and fitness, kind of relates to the same thing. If I'm doing this for my family, then I want to be there for them too, as long as I can be.
Yeah.
And I think it's easy to kind of forget your own health sometimes, especially when you're um, working very hard. Totally a workaholic, and I have to find that balance, and I battle it daily. Same with the mindset. I've got to check myself constantly and make sure I'm in the right mindset. Um, Especially nowadays, 2020 has been
Hmm.
insane.
Yeah.
And it's easy to kind of get down on yourself and blame COVID and this and that.
Hmm.
But yeah, you've got to be able to knock that off and just, I always say this, you um, can only control what you can control. Like
Yeah.
all the rest, it is what it is.
Yeah. No, I mean that's good. I think everybody, whether you're doing large multifamily syndication deals or just dealing with your day job and having to work from home and deal with maybe kids and every other thing. I mean, it's always a challenge. And if you want more, you got to take action. You got to take it into your own hands because, like you just said, you can't control what you can't control, but you can control what you can control. So
Hmm.
just hanging out on the couch and thinking about all of this stuff isn't going to get you there. You have to get up and take action. You got to have that mindset and that confidence and belief that you can.
Right.
Um, and then if you do all that, you just have to go out and make it happen. Well, this has been an absolute pleasure. I really am glad I'm glad that I had you on with us. If there's so much more to what you're doing right now, if our listeners want to connect with you, how can our listeners find more about you or connect with you?
Yeah. We've updated our website quite a bit lately. So if they go to Elevate CIG, stands for Commercial Investment Group, so elevatecig.com, they can find a ton of free content and events and just all kinds of stuff that we're doing. And if they want to go ahead and send me an email, they can feel free to send me an email at Jorge, Jorge, at elevatecig.com. And I can send over some of the checklists we use for due diligence and some other ones that I have there.
Awesome. All right, sounds good. And I'll include all those links in the show notes. And you're also on Instagram as well. Is it Jorge Multifamily?
Yep.
Okay.
Instagram, Facebook, LinkedIn, YouTube, and that's it for right now.
Yeah. No,
No,
that's
no,
awesome.
no TikTok.
Yeah. No, it's hard to keep up with it all, but that's awesome. I appreciate you. You know, providing those resources to people. I think that's helpful when you're trying to get started with this stuff. So go check out Jorge. I'll have the links in the show notes. He's got some resources for you guys. Jorge, it's been an absolute pleasure. I really appreciate you joining me on the show. And
Thank you.
yeah, good luck with everything you're doing, and hope to have you back sometime.
Absolutely, man. Thank you.
All right. Thanks, Jorge. And I want to thank everyone out there for joining us on this week's episode of the InvestNest Real Estate Investing Show. Be sure to hit the subscribe button so you don't miss out on any of our future podcasts. Again, we try to release every Wednesday and include a weekly guest to share their real estate investing journey. So hit the subscribe button and rate, review us. Also check us out on Instagram, Facebook, and Twitter at The InvestNest. And check out theinvestnest.com. Create your free investor profile and start networking with the other members. Thanks again, everyone. I hope you all had a great Thanksgiving. Stay safe and stay healthy. And we'll see you next time on the InvestNest Real Estate Investing Show.
Thank you for joining us on the InvestNest Real Estate Investing Show. Be sure to join theinvestnest.com and start learning and earning today.